A clean, upward trending market is the ideal scenario where traditional trend-following systems work perfectly, but markets eventually enter horizontal, range-bound periods, the trend-following graveyard. In sideways chop, reliable strategies trigger false signals, buying the absolute top and selling the bottom. To navigate these trendless environments, looking only at the absolute price level is no longer sufficient. You have to measure the market's internal velocity. Instead of asking where the price is, you must ask how fast it is moving. By deconstructing the mathematics behind momentum, RSI, and stochastics, we can engineer bounded oscillators that alert us to market exhaustion well before it shows up on a standard price chart. Anticipating a reversal requires looking under the hood of price action to measure the true rate of ascent or descent. The simplest way to measure this underlying velocity is raw momentum. This is a basic mathematical measurement of price differences over a fixed interval. The formula is straightforward. You take today's closing price and subtract the close from exactly 10 days ago. Below the price trend, a 10-day momentum line fluctuates around a zero line. Here, absolute price is rising, but daily gains are shrinking, causing the momentum line to flatten. As the rate levels off, momentum drops toward zero, signaling deceleration. Because it maps this deceleration, the momentum line acts as a leading indicator. It mathematically peaks and turns downward ahead of the actual price action, warning the trader that the current trend is running out of steam. While raw momentum makes conceptual sense, it contains two structural flaws that make it difficult to trade. The first is its vulnerability to erratic, false spikes. Because the formula subtracts a single specific point in the past, a sudden, sharp drop exactly 10 days ago will artificially force today's momentum line to spike upward, even if current prices have not actually moved at all. The second flaw is the absence of a fixed upper and lower boundary. Because momentum measures raw dollar differences, the scale stretches infinitely. Without a fixed ceiling or floor, there's no universal way to define too high or too low. To build a reliable tool, technicians needed to apply mathematical smoothing and contain the output within a constant fixed scale. J. Wells Wilder solved this exact problem with the creation of the Relative Strength Index, or RSI. This formula shows how Wilder reorganized raw price data into a bounded oscillator. Its core engine is RS. Instead of subtracting old prices, RS divides the average of up closes by the average of down closes over a set period. This division by an average smooths out the erratic daily spikes. Then, by inserting that ratio into the broader formula, the output is mathematically forced into a strict spectrum between 0 and 100. This chart demonstrates the result. Traders now have a standardized scale where market extremes can be universally mapped, typically at the 70 line for overbought conditions and the 30 line for oversold conditions. By abandoning absolute dollar differences and calculating relative win-loss ratios, RSI established a reliable, defined boundary for momentum. Another solution to the boundary problem is the stochastic oscillator, popularized by George Lane. Lane based his indicator on a specific market observation. As an uptrend matures, daily closing prices tend to cluster near the absolute top of their recent trading range. Looking at the mathematical definition of the stochastic %K line, you can see how it calculates exactly where the current close sits relative to the recent high-low range. If a market trades between $0 and $100 over a 14-day period, and today closes at $90, the stochastic reading is 90. This chart shows how the indicator is practically applied. It utilizes a fast solid line, %K, and a smooth dotted line, %D, both oscillating between extreme boundary warnings at 80 and 20. While RSI measures upward to downward momentum ratios, stochastics evaluates exhaustion by checking if price clusters near the absolute edges of its recent history. A common trap in technical analysis is the assumption that an RSI crossing 70 or a stochastic reading over 80 is an automatic sell signal. Declaring a market overbought too early usually leads to premature exits from highly profitable positions. In a powerful bull market, the oscillator will frequently hit its upper limit and simply stay there. The indicator becomes pinned in the overbought zone for weeks while the absolute price continues to climb. Taking a short position merely because the line touched its mathematical ceiling is a dangerous move against a dominant trend. The extreme reading is an alert to pay attention, but the actual trading signal requires a structural breakdown in the momentum. Bounded zones tell you when a market is running hot. They do not tell you when the engine is out of fuel. The true predictive power of both RSI and stochastics lies in a concept called divergence. Divergence occurs when the absolute price chart pushes to a new extreme high or low, but the underlying velocity indicator fails to confirm it, making a lower high or a higher low. This chart illustrates Wells-Wilder's failure swing mapping divergence. Absolute price drops, dragging the RSI line under the 30 level at point 1. Price forms an even lower low, but RSI at point 2 refuses to drop. At point 3, RSI breaks upward, confirming momentum failed. Because oscillators are pure derivatives of price, they isolate internal deceleration. They've revealed the shifting physics of the market before the trend fully reverses. Using oscillators as blunt overbought or oversold triggers is a liability, but when applied to mathematically prove that a trend has lost its internal velocity, they become an indispensable tool for analyzing market cycles.